Very good. Once again, Jeff Benson coming back to you. Exciting news today. We're going to have a guest speaker, so you guys don't have to listen to me talk the whole time. Just a little housekeeping. We're going to talk for a few minutes, and then we're going to get into some of what I consider the most pressing frequently asked questions. It should take 20, 25 minutes, and then we'll open it up to Q&A at the end of the presentation, at the end of the broadcast. So once again, really appreciate you taking your time out of a busy day to talk to us today. What I would like to do first is introduce our guest speaker, and that is Brandon Yinger. He is the Business Development Manager for Victor. And what we're going to do is Brandon's going to start this off today and talk to you a little bit about what he does and what he can do for you to place business. This is really all about production and how he can assist you and his counterparts in placing builder's risk with our program. So without further ado, Brandon, I would like to see you take control, and we'll talk about this, what's going on here. Oops.
Well, thank you, Jeff. I greatly appreciate it. Good afternoon, everybody. My name is Brandon Yinger. I'm a business development manager down in Atlanta, Georgia. I manage Georgia, Tennessee, and Alabama for Victor Insurance, and happy to be joining you guys today. What we thought we'd do is kind of kick off and discuss kind of how I help you guys. Really, my goal is to help you guys place business for your clients. That's really my main goal. And part of how I do that, the first kind of thing there is act as a frontline underwriter. I know that not everyone's as familiar with Victor's product offerings as say we are. So times during the week, or over multiple times a week, I get brokers submitting risks to me. Hey, Brandon, do you guys think that this fits? Is this something that's eligible with Victor? Just today, for instance, I got a broker in Georgia that submitted. Well, one, he wanted to know if we did coastal risks, and then the one that he had happened to be within 400 feet of the coast. I let him know that we do offer coastal risk, but anything within 1,000 feet would be an automatic decline, or if it's on pilings. It's just, I let him know, and he was thankful that I was able to answer his question. He didn't have to take the time to fill out an app and submit it, only to be declined. And so, again, multiple times a week, generally, I'm answering those type things. If it's something that's a little hairy, or something that's a little bit too complex, I might kick it over to one of my senior underwriters to review and get a little bit more detail. But again, I really want to help our brokers place business with us, and so I try to make that easy for them. The next thing I do is I really help set up new agents with Victor and kind of review our product offerings. I get new brokers all the time. I sit down and I kind of walk through what Victor can do, our different programs, what our appetite is, and then kind of how they can help their clients. We've got Victor products. We've got a small commercial division called Dovetail. We've got ICAT, which is a catastrophe insurance. And so there's a bunch of different things that I try to help let brokers know that these are things that we can offer. Next is register new users for V Squared and provide live demos. Very important to Victor Insurance and for you guys. Our V Squared is our online portal, as probably most of you guys know. I believe 85% of our builder's risk quotes come in through V Squared, so thanks for that. But there's more programs on there besides just builder's risk. We've got small A&E, we've got real estate E&O, we've got individual appraisers, cyber insurance, and then coming later this summer, early fall, we're going to have nonprofit. So these are just great programs that you can go on there and quote bind and issue and do things from the comfort of your desk, or if you're still working from home, you can do it from there. So that's another great thing that we offer. Next, provide market updates when there's disruption in the marketplace. So in talking with brokers across my region every day, you hear about different things that are going on. It could be a carrier that's exiting the marketplace, or non-renewals for certain risks or certain values. And so then when I'm talking to other brokers, I can say, hey, do you have any of these risks? Is this something that you guys have? And if so, would it be an opportunity for us to be able to help you in the future when that non-renewal comes, or you can't place any new business? And then lastly, probably the most important thing is to foster kind of the distribution relationships. As I said off the top, we're really here to help you guys place business. I've been with Victor for a little over 2.5 years. I know there's probably people on this line that I've never met. So there's been a lot of Zoom meetings. There's been a lot of phone calls over the last 15 months. But really, we want to get back to doing things face to face, sitting across from you, going to lunch, going to dinner, getting to know you and your staff and kind of what it is that you guys are looking for and seeing how we can help each other. That's kind of the main thing that we do as business development managers is, again, try to help you guys place business. So with that, let's go ahead and get into the questions, Jeff. How's that sound?
Fantastic, Brandon. I do appreciate that too. I just want to as a program manager, more on the underwriting side, we greatly appreciate Brandon and his distribution team and what they do for us. Definitely makes things go a lot smoother. So now we're going to get into the technical side of the business, and we'll run through these pretty quick, but these are questions that we literally get pretty much every day. Oops, went backwards here one time. So what is covered under equipment breakdown? Brandon, was I supposed to take this one or you? I think
that was yours. Go for it.
All right, well, let's talk about equipment breakdown very quickly. And this is right off of the form. This is what's covered, but the so what of equipment breakdown is, it's a broader coverage than testing. We get asked every day, can I do testing? The answer to that is yes, we can, but it's a much better coverage to do equipment breakdown. It's and what's covered is everything you can see on this page. I won't read it to you, but the so what of equipment breakdown is artificially generated electrical surges are covered. On testing forms, they're not. So it's actually a broader coverage than testing. So what an equipment breakdown is probably should be added to all policies. It is an optional coverage in our program. It costs a penny, so it's not very expensive. Penny per 100 of values. And when you write it, you have the full coverage of the limit of the policy. So I think the so what of all of this is equipment breakdown is a very broad coverage. It's very cost effective, and I strongly recommend it for the class of business that we write. Can you define soft cost? This is a question we get untold number of days. And I think
this is probably the number one question we get, right, Jeff?
It pretty much is soft cost. There's a lot of confusion in the marketplace. They confuse it with business income and rental income and delay in completion. So
yeah, I'll take this one.
Take a stab at defining soft cost. See what we got.
Yeah, so I'll give the technical answer, and then you can go and follow up with some real life examples. So, we'll pay the actual soft costs arising out of a delay period to the extent such as expenses are actually and necessarily incurred by you to enable you to begin your operations in the manners originally planned. The soft costs must be incurred during the delay period, and such delay period must be caused by or result from direct physical or damage by a covered cause of loss. So within 100 feet of the premises shown in the declarations or while in transit. So Jeff, why don't you give us some examples of how that?
Yeah, let's kind of demystify this a little bit. I think it's interesting. So we're insuring a house that's being built and the fire burns it down. Obviously, that's a covered peril. So now we have to rebuild the structure. As you rebuild the structure, there's certain soft costs that reoccur. Engineering fees, architect fees, premium insurance premiums, interest on construction loans, all of the more abstract things that you don't think about, but they reoccur. So that is the soft cost. It's these reoccurring expenses that, because of a covered cause of loss, they're going to reoccur when you rebuild the structure. A normal rule of thumb is about 10% of the value. So if you're building $1 million home, about $100,000 of that is soft cost. So if there's ever a doubt, we do have worksheets where you can sit down and do a soft cost worksheet. It's more of an accounting exercise to determine how much you need, but that's the general rule of thumb. Next question that we get.
Right. How you determined? I get this one quite a bit, Jeff.
Yeah, I do too. So an agent will call and say, well, I don't know, I know builder's risk is a broad coverage. What do I write the policy for? So we're going to touch on that. Labor, materials, overhead, profit. Okay, those things we know. So the thing that I came up with years ago, a little formula, selling price minus land value equals completed value. Our builder's risk form is a completed value form, so this is what you need to write it for. As you notice, some things like delay in completion and soft costs are not included in that completed value. One thing we will do for you in our program is we include $100,000 of soft cost in every policy that we write. It's an automatic coverage. It can be increased if you need it to be, but $100,000 is included. A little competitive advantage that we have in the marketplace. But when you're asking yourself and when you're talking to your builders, they want to know what to write the policy for. Just remember that selling price minus land value equals the completed value.
Sounds good.
Good deal. What is covered by the base coverage form?
All right, I'll take that.
There you go, good.
So we've got a special proprietary form. It's a broad-based form, and we think we have the most built-in coverages in the market. We've got 19 coverages automatically included. And the good thing about this is for a typical builder, we feel our base form is very good and adequate for the coverages that they need. What do you think about that, Jeff?
Absolutely. I mean, a lot of times agents will add coverages because they think they need to. I'm never going to tell you not to sell coverage, but our base form with the automatic coverages built in is adequate for the vast majority of home builders and small commercial general contractors that we insure, as is. And just those are 19 coverages, you know, for the sake of time, I won't go over all 19 of them. Maybe I could if I had to, but soft cost is one of those, by the way, it's built in automatic.
Good to know.
All right, next question.
All right, can we insure a project with multiple buildings? I get this often as well.
I like this. Yes, we can. Next question. No, I'm just teasing. So yes, we can. We can insure multiple buildings on one policy. One thing that happens a lot is obviously we have a house with a detached garage or a pool house, or it's a rural thing, might have a barn or a storage facility. We can insure that easily on the same policy. We can even schedule a number of policies if you had a builder building something in a close proximity of each other. We will work with you on that. And lastly, we do reporting forms. So if you have a builder building a number of homes, we can write a reporting form policy. It's really, and we can do that based on different reporting of inventory, be it monthly, bi-monthly, semi-annually, annual. There's a lot of different ways we can do that. So just keep that in mind, all on the same policy. Next question I get a fair amount is, why is protection class important?
All right, I'll take this one, Jeff. So I sets the standard for evaluating properties, and there's numerous aspects of fire control that to go into that. And it goes from 1 being the best to 10 would be unprotected. Both 9 and 10 are considered unprotected. And some of the factors that go into that rating would be the quality of the fire department, fire alarm, communication systems, and then the water supply are all factors that kind of go into determining that that protection class. Do you have any more details on that, Jeff?
Yeah, a couple of things I'll touch on real quick, because we get asked the question, what's the so what of this? And well, our rating base is based on certain things, our exposure, based on the construction, you know, what is the construction, frame, masonry, non-combustible, so on and so forth. The occupancy can impact builder's risk. And protection. Protection is ISO protection class. So the rates in the protected areas are about half of what they are in unprotected areas. And how does something become unprotected? Well, certain things like distance to the fire department, the distance to the working fire hydrant, the water supply itself, all of these things are factors that the ISO uses to evaluate an area. And this is not subjective. I get some agents sometimes want to argue with me and be like, not argue, but they say, I think it's really a 7, it's not a 9. It is kind of is what it is. So, by all means, give us a call and we can talk about it, but it is critical to the pricing and eligibility of the product, of the risk.
Good to know.
Next broad question we get.
Does this risk fit our program?
Get that one every day, don't you, Brandon? I do too. We all do.
Yeah.
So we're going to make that very simple. Ground up new construction up to 5 million frame and joisted masonry is our upper limit on values. So if it's less than that, we can entertain it. Ground up new construction up to 10 million on all other construction classifications. Non-combustible masonry, non-combustible, fire resistant, modified fire resistant. A few other small categories of construction that we'll take a look at. Residential and commercial. We love home builders. Number one thing we do, but we also love small commercial. As long as it fits those values, we'll write that all day long. You know, the Starbucks being built, Dunkin' Donuts, you'd be amazed. Walmart sometimes is less than 10 million. We've written some Walmarts being built. And the last piece of this is renovations and remodeling is also eligible. And that's both residential and commercial on the remodeling side. That's kind of it in a nutshell.
Hey, Jeff, quick question for you. So I know
Sure.
we don't skyscrapers and big buildings, but what percentage of things being built out there do we fit into our eligibility guide?
Good question. So the 5 million frame JM and the 10 million all other represent 97% of all construction projects in the United States. We all want to talk about the $30 million frame apartment or the $100 million skyscraper, but based on the percentage of risk being built, that's a very small percentage. As you drive around your area, wherever you're from, just look around what's being built. A lot of houses being built, small buildings being built, even medium-sized buildings. Those things all fit. So only 97%, Brandon. How's that?
Yeah. Seems like there's a lot out there.
Yeah. It gets me excited when I think about everything that fits. Explain what constitutes a major structural change and would the risk be eligible under your form?
So this comes up quite a bit in talking about renovations and remodeling. And so we've kind of broken this down into 3 different categories here. So we've got just basic remodel, interior finishes, exterior painting, replacement, interior fixtures, cabinets, no structural changes. That is something we can write all day, every day. Then you've got that plus minor structural. So everything listed above, but then you're also going to be looking at changes to exterior doors, roof replacement, ground floor additions, changes to non-structural things such as HVAC, plumbing, and electrical. Again, we can write those all day. Those type of risks will be referred over to an underwriter, but if it's it'll just be for a minor review, and those will be released quickly. Then you have the major structural things. Repair, replace, remove load-bearing aspects of the structure, adding stories, adding stairways or elevators, foundation work. Those are some things that, are something that's a bit out of our appetite, if you will, and requires heavy underwriting on some of those things. Would you say that's correct, Jeff?
Yeah, that's kind of it in a nutshell. We get these, and if there's ever a question, by all means, pick up the phone and call us, 800-944-7472, and we'll talk to you, because sometimes it's hard to figure out, is it minor, is it major? And we'll talk to you about that. Just some general rule of thumbs are things that we get every day. So if they're building a room addition and they're going to tie into the existing roof line and it's a horizontal addition, that is minor structural, not major structural. If they're going to add a 3rd floor on a 2-story building, that's what I call vertical square feet. That is major structural. I do think agents can be creative sometimes. And a buddy of mine called me and he goes, well, they're going to pick the house up and float it down the river. It's not really structural. They're not changing the structure. Now, I appreciated his sense of underwriting, but I had to inform him that was structural. So, like I said, we don't mind the phone call. If you can phone and call us, we'll talk to you about it. We run a lot of this. Probably a third of our book of business is renovations, remodeling. So it is something we don't mind writing. We're just going to underwrite it. Anything else you want to add, Brandon?
I think that hits on all those points. Thanks.
All right, so the next screen, I will let Brandon talk to you about this.
Yeah, so as you can see, these are some of my partners across the country. As I mentioned, we're just really here to help you guys place business and help your clients. When there's risks that come across your desk or you find out in the community, if you've got questions about does it fit into Victor's appetite, please feel free to reach out to one of these folks, and they're always happy to help you. And really, again, just thank you for the time, and thanks for being on this call. We appreciate y'all's partnership, and look forward to meeting with the folks in my region soon.
Great. And I will just touch on this. I work very closely with this whole team, and they are geographically dispersed throughout the United States. I will say, as a program, we readily write in 48 states now. So we love those 48 states. Still working on Hawaii and Alaska. We're not in those states yet, but the rest of the country is covered. So we have, boots on the ground, local experts in all of these areas. We know that will help you out immensely. I think we did that in record time. So what we're going to do now is open this up to questions and answers that you may have. Any questions from a distribution standpoint, from a product standpoint on builder's risk, we're here to help. So Jillian, any questions?
There are a few. First, we have, this one came in pretty early in the presentation. For major renovations and renovation projects, is it better for the building owner to control the builder's risk with their existing builder insurer to maximize or to minimize claims adjusting?
I'll let you.
Really, to me, I'll take a stab at that one, Brandon. To me, it really doesn't, from that standpoint, whether it's the owner or the GC, you as an agent, and we've had some webinars on this, you have to, who is your insured? Who is your client? If your client is the owner, I would encourage them to have the builder's risk. If your client's the general contractor, I would encourage them to have the builder's risk. I mean, you control, you want to make sure that your insured, whoever you're working with, is covered the best. So it really doesn't matter whether it's the owner or the GC, you're trying to protect who your client is. So the form is going to stay the same regardless of the name insured. So hopefully that answers it.
All right, I'm going to throw in another one on renovations. How does builder's risk for renovations coordinate with coverage for the existing building?
All right, so two types of renovation coverage that we do. First of all, we do write some where it's a tenant build out. They don't own the building, they're just going to build out the space. So it's renovations only. Those are easier, renovation only policy. Next type of risk that we have is someone that's going to buy an existing property, renovate it and resell it. So that way we have not only the renovations, but the existing structure on the same policy. We have to endorse the policy to cover existing structures. There's a little few nuances to that. One would be valuation. Everything we do on existing structures is actual cash value, but we do have an agreed amount endorsement option. So I would encourage you to do that, to place that agreed amount on there, and basically we'll agree to the value of the existing structure, and should not be any problems on that respect. So we readily do it. We will underwrite the risk though. We're going to look at that existing structure to make sure it's structurally sound, because theoretically we're providing permanent coverage on that structure from day one. So we have to look at it closely from an underwriting standpoint. Good question.
All right, I'm going to combine these two because they're relatively similar. Are there any PCs that are ineligible? And do you have a max value for frame for PC9?
I got the second part of Brandon. You want to take that one? Do you know that one or not?
Can you, I'm sorry, I missed just the first part of that.
Are there any PCs that are ineligible?
I guess I'll take it. I didn't hear it. That's why I was hoping you heard it, Brandon.
Okay.
So let's just go over this really quick. The protection class 1 through 8, our maximum frame is 5 million. Now that doesn't mean we're always going to do it. We're going to take a look at it. There might be other factors. What's going on the West Coast these days, maybe a little brush fire here and there. So we're going to reserve the right to underwrite those risks in the brush fire areas. We take a hard look at coastal areas. Maybe we'll do higher value, maybe we won't. That's really risk by risk. So it really does depend, but 5 million is our max limit. We will not go over 5 million. The other one is PC 9 and 10, or maybe S9 unprotected. We probably will not do 5 million in PC 9 and 10, but we do. I wrote one the other day, it was 2.5 million. So we're just going to take a look at it. And just to give you an idea, we have a short questionnaire on PC 9 and 10, and we're going to ask things like, what is the water supply? And, what is the rating of the volunteer fire department that's going to respond? And, so there are different, there's ratings on volunteer fire departments. So I've seen some very good ones and some that maybe aren't so good. So the answer to the question is it's worth submitting and giving it, let us take a look at it. We'll talk about it.
All right. How does your policy differ than that of an E&S carrier?
All right, so as Brandon said early in the presentation, this is a proprietary form. So over the years, we've added coverages, automatic coverages, we've extended certain coverages, we've changed when coverage ceases. It's kind of morphed into this, what it is today, which I think is arguably the best base form in the marketplace. So we have very, very broad coverage that's built in automatically. From what I've seen in the E&S market, it's kind of the opposite. I'm not going to pick on anybody in particular. But usually their forms are rather hollow. I've seen forms that don't include theft coverage. I've seen forms that limit who the insured is, when coverage ceases. You have to be very, very careful when you're dealing. Well, actually, it's uncontrolled in the Marine for the most part. So whether it's E&S, admitted, not admitted, you need to look at the form. If you ever have any questions about a form, pick up the phone and give me a call and we'll talk about it. So yeah, don't assume they're all the same. Good question.
All right. Are we a market for installation floater risk?
Brandon?
We can certainly help with those. We do those quite often, but it's going to be something we're going to look at for sure. And Jeff and his team will definitely underwrite those, but we can't help with those.
I like that. That's a good answer, Brandon. No, but yeah, installation floater might be, your contractor is the electrical contractor, and he's only his interest is insuring the electrical work for a project. So we could do that. It could either be under the GC's builder's risk policy, or we could write a separate installation floater, whatever you need.
All right. Are you able to insure a project already started, in particular a remodel?
Are you feeling it, Brandon? You want to take that one?
Yeah. We can definitely take a look at it. Just kind of depends on how far along in the project you are. If it's, I got something sent to me the other day that was 85% complete, that's probably not going to be something we are going to look at. But if it's 20, 25%, that's definitely something I think Jeff and his team will be willing to look at.
Good answer. Yeah, I mean, so if it's less than 30%, it actually flows through our digital platform. It'll flow through the underwriting of that. If it's over 30%, it generates a hold, and we're going to take a look at it and talk to you about it. But at some point, if it's too far along, then yeah, we can't do it. But it's as always, it's worth a phone call. Give us a call, see we'll let you know.
All right. Does the policy have exclusions caused by damage from cranes?
There is no particular exclusion for a crane. Now, we don't, it gets a little abstract here. If you're going to talk about hoisting and rigging, that's a separate coverage if you're actually insuring the crane contractor. But if the crane would damage the building, I try not to answer claims questions too much, but that would probably be covered. I don't think it's excluded. So, interesting question. But
Can
I would
builders risk be
hope
canceled?
that the contractor, the crane operator has their liability coverage in place. So that would be the best bet. Anyway, I'm sorry, go ahead.
No, sorry. Can builders risk be canceled prorate or renewed if needed?
Okay, we do it a couple of different ways. Our standard policy, our standard practice is fully earned premium. But if something goes beyond a year, we've written it for a year because of delays or whatever, we could either write it pro rata the second year, or we could extend it in shorter time periods, like extend it for a month, 2 months, 3 months. We do that every day. So we will work with you on that, whether it's going to be prorated or just extended time by time. We'll be pretty flexible on that. Good question.
All right, Jeff, we do have a couple more questions. Do you want to keep going?
Sure.
Okay.
Brandon, you still available, Brandon?
I'm here. Yeah.
Cool.
All right. How do you cover increases in material costs during construction?
Okay. I was going to see if Brandon wanted to jump on that one, but I'll jump on that one. So
Yeah.
we have a coverage called contract change endorsement. And what you can do is add that to the policy, and it comes in increments of 10, 20, or 30%. So if you're writing $1 million building and you add that contract change for 10%, if something happens during the project, you have an additional 100,000 coverage. That's one way of doing it. The other way is, as soon as the builder makes you aware of the increase of the value, you let us know, and we'll increase the value of the project. So either contract change coverage, or simply let us know about the change in value.
All right. Will you write a remodel that has had a fire loss or a claim?
I'll give you my standard underwriting answer. That depends. So when there's been a claim, we're going to look at it very closely. We're going to say, well, how much damage was done. Obviously, if there was a fire and there's structural damage to the building, we're not going to do it. But if it was a little tiny fire, a little bit of smoke damage, chances are we would do that. So it really does depend on the claim itself. We're going to take a look at it. Sometimes when there's been an event in an area, Maybe there's been a flood or something, and so there's a lot of damaged property out there. It's a good time for us, because we have a lot of people that go in and fix things up, and we've been known to insure those type of contractors. But if we are insuring the existing structure, we are going to underwrite that structure, depending on what would happen to it. Good question.
Okay. Will your policy cover waiver of subrogation?
Ooh, this one, we could have built another webinar on this one. So if we, like, for example, if we have a contractor that's building Walmarts and they want to hold Walmart harmless, so you're going to waive subrogation against Walmart. We do that every day. So I guess it really depends. That we will waive subrogation in some cases. We will not do express waiver of subrogation where we waive subrogation for all parties involved. We will not do that. So really, that's another one of those ones where you're going to have to talk to us on it and see what you got, what you need to do. Sometimes if a contractor is doing work for the municipality, you have to hold the municipality harmless. We can do that, no problem. That might be the next webinar. We'll think about that. It's a whole webinar on that.
All right, we have two specific questions for California. First, is a risk meter such as CoreLogic helpful with a California submission?
We think it's a great product because that's one of the main products we use in underwriting. We use risk meter, CoreLogic, determine the crime factor, the brush fire factor, the earthquake, flood. We use risk meter, CoreLogic, so we run that ourselves on every building we insure. So yes, we think that's a great product. If you have access to it and want to send it in, great, we'll take a look at it. But we do run that also ourselves. It's a good product.
The second California specific question is, are there any issues for the California wildfire zone?
Well, I'm going to say there's always an issue. We're going to look at it. I was looking at CAL FIRE, which is the website that we look at a lot. We use risk meter, CoreLogic, and we use CAL FIRE, mainly those two sources to evaluate what's going on. And we do take a hard look at it. And if they're going to be building on the edge of these national forests and high-risk zones, we have to think about whether we want to insure that project or not. But having said that, a lot of construction in California, and we like California. We're relatively new there with this product, but we definitely want to write business in California. We are open for business.
All right, do you accept submissions from the wholesale market?
Yeah, I always like to say we underwrite the risk more than we underwrite. I shouldn't say we don't. Of course, we treasure our relationship with our agents, but we do some work with wholesalers and we do work with retailers. It's an open brokerage platform, and we'll gladly talk to you.
Does the change to the general contractor create any issues for the policy?
The short answer is yes. We do underwrite the builder, and so if it changes, we're going to ask some questions. It's a reputable builder. We obviously want to know why it changed, what happened, but could be fine. Builder has good experience. Maybe they just got in an argument with the owner, or whatever happened. So we'll take a look at the risk as it stands and evaluate it based on that. But if it's a good builder, it shouldn't be a problem.
Will you write renovations for historical buildings, such as a library?
If it is on the historical registry, we will probably not write it. If it is not on the registry, but it's simply old, we will take a look at it. The problem you have with very old historical buildings is valuation. It's very hard to evaluate. And the other thing is, how would you possibly repair a 150-year-old marble top or something? It's just very difficult. So if it's on the registry, we would probably not write it. If it's simply old, we'll take a look at it, and we do write some of that.
For commercial construction, would the completed value be the same as the contract amount?
It could be, but even with commercial, I would always fall back to what is the ultimate selling price of the project, because there is a selling price out there, and then what was the land value? We have a developer that bought a piece of land and now he's going to develop it and build this building. He knows what the land cost him. Take that out of the contract and say, okay, that's what you need to insure it for. It works whether it's residential or commercial. And the other thing too is if it's ground up new, especially depending on what is the construction, is it frame, is it non-combustible? We have a pretty good idea what those things cost to build in different parts of the country. So we can look at the cost per square foot and get pretty close to what it should be. And if it's way out of whack, we'll let you know about it. And it varies dramatically by where you're at. To build a building in South Florida, or to build a building in Central Indiana, or to build a building in Los Angeles. Very, very different costs. I'll let you determine which one's the most expensive, but you just get the idea. They do vary geographically. Brandon, would you echo that?
Yeah, I think that sounds good.
Okay, does the waiver of subrogation extend to the architect?
Like I said earlier, we do not do an express waiver of subrogation. You would have to add each entity that you're waiving the subrogation against, and we're going to evaluate that. It really depends on the individual risk. So you can't just attach something and waive all the subrogation. We do it case by case, entity by entity. And builder's risk is a little different if you think about it. It's not GL, so it's a different line of business.
Okay, final question.
Okay.
For coastal, do you use open ocean for any water, like a bay or inlet?
I'm sorry, Julian, I didn't catch that one. What was that?
For coastal, do you use open ocean for any water, such as a bay or inlet?
I gotcha. So, I sound like a politician a little bit today. So the standard response is we measure from the true coastline. So when you look at something, there is a coastline. It's a coastline of a large body of water. If there's a bay or a river or a canal or something, we will work with you on that. But it really does depend on the area. Brandon has a lot of coastal area in his territory, and he understands that we watch our amount at risk in these areas very carefully. So parts of the year we might write more business than other parts, but we will take a look at what you got. And CoreLogic risk meter is great. You can put the address in, and it'll say distance to the the largest body of water, which is usually the ocean or the Gulf, and that's a good sign. That's what we're going to use. If it's on an island, we're going to take a hard look at it. There's a lot of islands on the East Coast. We take a hard look at it. Little thing in New York called Long Island. We do write business on Long Island. So we look at the distance both to the ocean and to the sound north of Long Island. So it just depends. Good question.
All right, I know we're 10 minutes over, but we got through them all.
Well, I'd like to thank Brandon for taking time to co-present with me today. I think you did a great job. And as always, I appreciate all of your time on the broadcast. Look forward to our next one next month.
Thanks, everybody.